The Consumer Bankers Association is pleased to welcome you to today's webinar, The Graduation Effect: How to Unlock Long-Term Value from Today's Customers, presented by Curinos. My name is Isabel and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunities at the end. You may submit a question at any time by entering the questions into the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. It is now my pleasure to introduce our speakers, Sarah Welch, General Manager at Curinos, Olivia Hamel, Director Advisory at Curinos, and Tazmin.bailiffcurtis, VP Product Management with Curinos. Welcome, everyone.
Thank you so much for that lovely introduction, Isabella. And you can jump us to the next page. Before we dive in, kind of what is Curinos, just in case you haven't come across us or aren't familiar with us. We are a decision intelligence company, and our entire focus is on helping financial institutions make better, faster, evidence-based decisions that drive customer value kind of at every stage of the relationship, from acquisition to deepening and retaining. And as Isabel so kindly introduced me, I am Sarah Welch. I'm the general manager of our consumer solutions. So everything from pricing optimization to decision intelligence platform more broadly. And on the phone, we also have Tazmin.bailiffcurtis, and I will let her introduce herself.
Nice to meet everyone. I lead product management for our consumer division. That includes, as Sarah mentioned, our decision intelligence, customer engagement, and pricing platforms. Olivia, I'll hand it to you.
Hi, Olivia Hamel. I'm a director in our advisory consulting practice, and I do my work around core customer growth strategies.
Excellent. And you can jump us to the next slide. Kind of as we dive in, we'll start probably with a little bit of the reality most of you are living in, which is acquisition is getting more eye-bleedingly expensive by the day. Primacy is noisier, and more and more of our customers are sort of opening relationships digitally, which is great, but not always great for quality or depth. And so as we go through this content, I think there's sort of one central idea that we would want you to carry through, and that is you need to figure out how to invest in those customers who are going to graduate to higher levels of value with you. Some of those customers look really small on the first day, but kind of will quietly become some of your most valuable customers if you can kind of spot the signals early and coordinate how you're interacting with those customers to drive to that value. The banks and credit unions and financial institutions that are going to win are the ones who will be able to kind of identify that durable customer value and kind of get all of the functions rowing in the same direction in terms of activating on that insight. So our goal today with the content that we have is to help you see where graduation potential is happening in your portfolio and maybe what's in the way of enabling you to capture that. And so let's dive in. If we jump to the next slide, let's put some real numbers behind the problem that we're tackling here. And the first part of the problem is the cost to acquire. So if we look at that left-hand bar there, when I say eye-bleedingly expensive, the CPAs today, if you go back up to the previous slides. So yes, there. The CPAs that we're paying today are significantly higher, 50% higher than they were in 2019. We're all paying more for every customer that we're bringing through our front doors. More and more, if we look in the middle of that acquisition, is shifting to digital channels. It's gone from roughly kind of 10 to 12% up to 35% plus for new to bank checking accounts. But channel quality is something that's pretty uneven. When we look at the difference in quality between customers who are coming in through branch front doors versus customers who are coming in through digital front doors, you can see, 6x, 7x, 8x gaps in the amount of deposits that you see in the first 6 months, not to mention the attrition gap that we see often as well. And then on the right-hand side, it used to be that when you got somebody in the front door as a new checking customer, the tenure was long. But you can see a lot of the traders have 2+ years of tenure. 2/3 of them have checking accounts, which means that on the retention side of the equation, we're losing long established multi-product value. So significant challenges here in a hyper competitive environment. So, the obvious question here is which customers merit attention. So if you jump to the next slide. There are usually significant differences in value to the bank based on segment. So if we look at the customers that are in motion for that new primary relationship, the vast majority are more paycheck to paycheck or mass affluent. But the vast majority of deposits and kind of immediate value from an acquisition standpoint are in we call them Henry's, high earner, not rich yet, or the affluent segments of the population. But you can see they're a much smaller kind of sub 15% of all of the folks who are in motion for a new primary relationship in any given year or month. And the return profile that boards and kind of alcos want to fund is more in that Henry and mass affluent group, because they are bringing higher initial balances and more products per customer. If you look at the right hand side of the equation, you can see that it takes many fewer incremental new to bank customers that are more mass affluent or high net worth than mass market to drive to your goals. So the question from an acquisition standpoint we need to ask isn't how many new customers did we add, but how many high quality customers did we add? That's where kind of most institutions are rebalancing their spend from an acquisition standpoint and focus, right? We certainly hear, many banks and credit unions shifting to kind of focus on getting more than a fair share of that more affluent customer base. And on the next slide, that's all well and good. But one of the things that's extra challenging, even if you get customers in the door with the right balance of kind of mass market to mass affluent, the fragmentation makes figuring out what the future value of that customer is likely to be very hard to read. This is a stat that when I saw it for the first time earlier this year, made the hair on the back of my neck stand up a little bit. In 2019, 7% of those customers opening a new kind of primary relationship with an institution had 4+ checking accounts. Today, that's 50%. So that relationship fragmentation has just absolutely exploded. And more relationships more checking relationships ultimately means generally shallower primacy signals. So traditional proxies might mislead you. And if we jump to the next slide, it's even more pronounced in the more affluent segments, right? Fragmentation looks more like a feature than a bug for these more affluent segments. When you look at secondary banking, it's looks more like the norm. There are 6.6 secondary relationships on average, more than kind of any other segment. And product footprints are also more multi-bank, 2.9 products on average, and 2 products per secondary. So we need to figure out how to win share of wallet, not just the first account. And so if you jump to the next slide, when you layer on industry dynamics, capturing that long-term value becomes the line between profitable growth and essentially subsidizing your competitors. So just to kind of recap, half of recent purchasers are juggling multiple relationships, 4+ checking. Primacy is certainly not a one-size-fits-all, and less than half the population is defining that by direct deposit. You have a much more competitively active environment. You have fintechs and direct banks now winning almost 60% of the primary checking, along with national banks capturing a disproportionate share of the affluent switchers. And those advantages are growing over time. And then when you add on some of the, I like to say, cloudy with the chance of meatball headwinds like tariffs and the drag that could put on household cash, cheap growth at a customer level is not our reality today. So that's why it's incredibly important for us to start getting more surgical about determining who actually pays back here. And if you jump to the next slide, as we look at kind of our wide angle lens on customer behavior and data from across the landscape, what we see is while we're all turning our attention to mass affluent, the reality is that 20% of your mass market customers will likely graduate into higher balance tiers within 5 years. And that starts to change the math a little bit, right? If we invest in the right 20% early with the right kind of interactions, we could lift that rate of graduation and the lifetime value that follows. I think part of the message here is and as a former CMO, certainly guilty of this, definitely over-index on three month or month 3 kind of balances and the ROI payback of that. But I think that's an initial snapshot, valuable, yes, but if you pull back the aperture a little bit, you realize that that 20% is really important. So we need to figure out who those customers are going to be in both the more affluent segments and the mass market segments, because that graduation impact is compounding over time. So let's jump to the next slide and take a look at that. So as we look at the left-hand side, this is a picture of attrition among mass market consumers over time. And the reality is, yes, mass market decays faster early on. However, back to those who stick with you and graduate, Those who stay don't just stay, they scale, right? So on average, the mass market is growing 5x their month 3 balance by year 3. On the affluent side of the equation, by contrast, we see them actually kind of declining in their balances with you over time. It's sort of, they have optionality and they're going to take that optionality. They're more kind of rate sensitive, and exercising the optionality that they do have versus kind of committing and growing. So the implications here from a product and marketing standpoint is, how can we think about building kind of experiences within the product and how we deliver them in marketing and banker interactions that nudge those customers to graduate to those higher levels with us? How do we, from a treasury and a pricing perspective, think about how do we start to separate those more durable deposits from the more promotionally sensitive, and manage that effectively in a way that's growing the sort of longer term balances in the healthiest way possible? And how do we coordinate at a banker level the interactions and the signals for bankers that this is a customer that's likely to stick and grow, so that we're, again, rowing in the same direction across the institution at a customer level to move those who are likely to graduate to those higher levels and maybe get more than our fair share of those with options to be graduating with us rather than exercising the optionality that they have. So that's why we need a predictive lens at the customer level. And if we jump to the next slide, this is hard, right? We can have 2 customers today. We have Avery and Jordan here, and they are identical, right? From an initial snapshot perspective, they have $5,000 in their checking accounts, and the traditional account data would see them the same way. They're both mass market, but under the hood, they couldn't be more different. Avery just started a new job, doesn't have any other local banking relationships, and is probably looking to be buying a house soon. Jordan uses digital providers for his daily transacting. He moves money to Robinhood every month, and he relies on his partner for major financial decisions. And account data alone isn't going to tell you this. And this is the sort of identification problem to some extent that everyone is facing right now. Who do you want in your base? How do you spot them as early as possible? And what kind of treatment do you give to them differently? So if we jump to the next slide, what we are looking to do is establish a rich 360-degree contextual understanding of these customers that can start to reveal the difference. And that contextual understanding can be, not just what a customer has at any point in time, but how those things are shifting, how the customer is actually using the account over time, how they're using and interacting with features and functions, digitally or analog, with the bank or institution overall. So as we look at this, Jordan is showing repetitive transactions to the same vendors. He doesn't open emails. He drains his online, account every month to send to Robinhood or other competitors. Isn't visiting branches compared to Avery, which Avery is giving more signal of deeper, broader interaction and engagement with the institution. But having a rich contextual understanding also isn't enough, right? Because there's a synaptic gap between knowing something about a customer and actually being able to activate in an intelligent way on that signal. And, there's at a customer level, no way, that just not humanly possible for your teams to be monitoring and then pulling levers one by one, customer by customer. What you need is a platform that is continuously monitoring and scanning the horizon for signal of graduation potential, and then basically directing various levers for activation, whether those are marketing levers, pricing levers, banker enablement levers, to act within guardrails that you define that are going to move the needle on customer lifetime value. And personalization is a super hyped, overworked word in pretty much every industry these days, but that's really what the kind of personalization potential is long term, right? It is aimed at individual level monitoring and activation that is optimizing for customer lifetime value, not a click, not a response, but the outcome. And to do that consistently at a scale that makes sense, you do need decision intelligence, not just insight dashboards or segmentation insight. So if we jump to the next slide, the right kind of decision intelligence platform is going to evaluate thousands of customer contexts all the time, sometimes real time, sometimes multiple times a day, sometimes daily. But with enough frequency to understand kind of the deltas and the degree to which those deltas are useful signal for somebody that is likely to graduate. And for each one of those contexts, those contexts are usually made up of hundreds of variables, right? They could be tenure variables, balance variables, trajectory variables, engagement variables, transaction pattern variables. And together, those start to paint a picture of a customer that is indicating likelihood to graduate or not. And being able to monitor those signals as they emerge is really important. And so in a typical week, for example, our decision intelligence engine for a typical institution will analyze 3,000 unique variables across many millions of unique customers and make, many millions of unique decisions about marketing interactions, pricing or promotional pricing and condition decisions, or engagement, banker enablement kind of stage direction decisions, all with the goal of moving the needle on customer lifetime value. So the impact, when you can eliminate that synaptic gap of like, oh, I know something about this customer and now I want to be able to act on that, is really significant. It's significant on individual product levels, and it's it's significant on a macro institutional level. On a macro institutional level, we see deltas where banks that can do this have, 5 to 10% incremental improvement in customer lifetime value as measured against kind of business as usual operating holdouts. On individual, programs, if you want to do balance augmentation, if you want to, do cross-sell and deepening, we see 2x, 3x kinds of lift when you can eliminate that gap. So this ability to sort of identify who is likely to move up with you, and the ability to action on that as you're seeing those signals emerge is important for franchise health. I think the question is, as you think about your different roles, and we can jump to the next slide here, what does it mean from, for me to do this right? Having a lens where we're optimizing for or thinking about the customer value expressed and how should I be optimizing that customer value, you're going to be thinking about it differently depending on where you sit, right? Product teams are, trying to think about what levers should I pull and when. When you have a customer value lens, you're able to prioritize an investment, whether that's a promotional investment, pricing level investment, or a relationship pricing investment in customers that are most likely to move up and graduate with you into either very rich deposit relationships or multi-product relationships. For marketers, you're typically asking which customers should I prioritize for activation? How should I engage them? And with the right customer value lens, you can now prioritize the nurturing of customers who show the highest promise to move up with you. And you get more than your fair share of those because you're sort of ahead of the game on those customers with high potential, not just those customers with big balances today. For those in treasury and finance, what are the customers that are going to drive favorable funding, and how, with the right lens, how can we differentiate the durable deposits from the more rate chasing folks out there? And for those managing retail, who should I point my bankers at, right? How should my bankers engage with customers in a way that makes them more likely to move up? And with the right value lens, you can prioritize efforts for bankers to be able to connect with customers that are showing signals of being ready to graduate and sort of reaching them before those other 4 accounts have an opportunity to pick them off. So let's jump to the next slide, which is a poll. And before we kind of go into what might be getting in the way, the question for folks is, which one option best describes how you use customer value-based insights today? Either it's a core element of our execution and customer engagement, we use this consistently across teams, but primarily for decision support. Different teams have different views on customer value and it's used inconsistently, or we don't really have it, not used consistently in our execution today. So pick the one option that best describes you. And while we wait for that to fill, maybe we jump to the next slide and Olivia can walk you through a little bit of kind of the challenges that we see in the way typically of the ability to do this.
Perfect. Thank you, Sarah. So want to get into sort of why is it so difficult to action against customer value-based insights? If it were easy, you would probably be doing it today. But jumping to the next slide, we really see three core challenges here, and it really boils down to the very way our organizations are structured. It means we're set up to miss the graduation potential, and even to invest in the wrong customers. And they're not really one-off misses, they're built-in blind spots because of these organizational structures. So 3 reasons these come to be. The first is around data fragmentation, where we're unable to see the full view of a customer across the bank and understand their relationship with us more broadly. The second is around challenges in coordination and orchestration, where it can make processes slow and disjointed when there are a lot of handoff points between marketing, product, pricing, and different stakeholders at the bank. And lastly, misaligned incentives drive siloed results, where teams are optimizing for short-term, tangible product results, but missing the long-term customer opportunity. We'll deep dive into these a bit more. It looks like right now, sort of the different views on customer value is one of the big challenges there. But want to jump to our next poll on the next page and get an understanding of, if you could only solve one of these in the next 6 months, which would unlock the most value for you and your organization? Is it solving for the data fragmentation? Is it solving for that coordination and orchestration across teams? Or is it solving for this piece of incentive misalignment across groups? We'll keep moving through here as you all respond to this poll and dive into these challenges. So I want to start first with data fragmentation. At its core, it's really around the lack of visibility to the full picture of the customer. This includes deposits, lending, investments, and how it works across systems. So this means that different parts of the bank view a customer very differently based on what they have visibility to. So as an example, the consumer deposits team may see a windfall of cash into a customer's account, but the premier or the wealth team doesn't get that insight. So they miss that opportunity to reach out and win the relationship. There are also opportunities here to think about integrating third-party non-financial data to get a better understanding of the full picture of the customer, right? As we think back to sort of Avery and Jordan, there were non-financial attributes at play there that dictate some of their customer value. And even when there are enterprise-wide pilots of data and integration initiatives, a lot of the processes around that can be slow and very resource intensive. Oftentimes, we see the aspiration of perfect stands in the way of good or great when it comes to data. Expanding visibility to the full wallet of the customer, even one piece at a time, is really important progress on this path towards actioning against customer value insights. Moving on to our second obstacle, it seems like this coordination and orchestration is also a challenge for a number of you on our call today. This has to do both with coordinated delivery and also the handoffs between product, marketing, pricing, and ultimately the technology and operations required to action against customer value. What can happen here is that there can be a campaign targeting those with high savings balances. That's a great way to take an integrated view of the customer across deposits and lending. But if lending ultimately declines them because they have insufficient history with the bank, despite having a high response rate among the customers who look valuable at the surface, the execution portion of converting them to opening new products is flawed there. Here, it's really key to be thinking about operating around the customer journey rather than by product or line of business. You can solve for this through coordinating delivery and better orchestrating across divisions through a uniform and aligned measure of customer value that provides a single source of truth for all to operate off of. Want to pause for a poll here if we jump to our next page, just to understand sort of what is that pain point for the coordination between marketing, pricing, and product teams for you today. How has that lack of coordination potentially caused you to cancel a major initiative, miss quarterly targets? Have you lost customers to competitors because you don't have that outreach at the right time? Or is there just an overall pain point around slowing things down with the process of things? You all a second to respond to that poll. Okay, moving on to our third and final obstacle. I think it seems like this coordination and orchestration slows things down. That's definitely one where it's important to see those customer cues and also be able to act on them in a timely way. Our last one here is around misaligned incentives. So often misaligned incentives can optimize for short-term or product-specific gains without considering what that longer-term sustainable strategy is. That can really come to life when you're thinking about a customer more holistically. What we often see is banks chasing balances for that near-term growth. But often on the customer side, who you see coming into your bank then are those rate optimizers. They're going to continue to chase rate if it's at your bank or if it's at somewhere else. So they're more likely to attrite, and they don't build those sustainable long-term relationships and ultimately can drive up cost of funds over time. The way that incentives exist in product silos, and this is really everything from KPIs for a division down to compensation structures, reinforce the siloed performance that mean we're thinking product specifically rather than about a customer holistically. And so on one end of the spectrum, there can be conflicts when different line of businesses own the same customer touch point. And on the other end of the spectrum, a real lack of shared accountability for that full customer experience and lifetime value. And so without that true measure of what is a customer worth to my institution, it's difficult to figure out a way to align those incentives. Going to our next page here, ultimately, solving all three of these foundational issues together really matters. The result here is greater than the sum of its parts. Having the data to back up customer intelligence, coupled with the coordination to take the right actions quickly, along with the right engagement or offer that takes into consideration the full customer relationship and their context. It's a hard equation to get right, but very powerful when you are able to execute on it. At Curinos, we've seen decision intelligence that solves for these three foundational issues result in nearly a 3x conversion rate when compared to a control group when engagement is centered around customer value and those timely customer cues. So executing quickly when the opportunity is there based on a uniform signal of a customer across their full wallet with the bank. With that, I'll hand it over to Tazmin to take us through sort of what does it look like to capture long-term value.
Awesome. Thank you, Olivia. I definitely come out of those first two sections sweating a little. To Sarah's point, it's a really daunting problem. There's so many facets to it. And so I want to touch on in a little more depth how to actually think about kind of tackling this problem, what type of enablers we need to invest in to really break this down and achieve success despite some of those constraints that Olivia mentioned. So if you jump to the next page, step one that we really think is critical is establishing customer value. And this seems intuitive, but you would be surprised how often this step kind of gets rushed past, or banks think they've already done it, or it's kind of happening in a silo. But this is a critical launching off point before really starting to think about the engagement and execution across our two different channels in kind of the acquisition space and the deepening space. This allows us to really unlock a deeper understanding of our customers, their preferences and needs. And I'll touch a little bit more on kind of the data aspect there. But the really important question that is kind of central to this problem space, which is prioritization. Which customers am I trying to acquire or engage with? Why? And based on what outcome? Solving this question and the more signal we have up front is going to be fundamental to how successful we're actually going to be at capturing lifetime value. And again, within each of our kind of two use cases, I'll touch on this in more depth a little bit on the tooling side, but there are kind of orchestration or components of ingredients that exist in these use cases that are fundamental to kind of achieving success there. And that's an operational question of making sure that we have the right tooling in place, the right coordination that comes together to kind of bring those two channels to life. And so jumping to the next page, let's talk a little bit about kind of the data aspect here. So again, data in itself, as you guys saw in the poll, Data fragmentation is a core challenge that is faced, I think, almost ubiquitously across our clients today. This is a really pretty picture to have on paper. It's really hard to achieve, whether that's due to outdated tech stacks, idiosyncratic cores that you guys are navigating, or just a bunch of different fragmented data that teams have gotten really comfortable using in different ways, but lack the infrastructure to really understand or tap into that broader spectrum. And so we see this asset, this kind of, customer spine, which is a word I'll use pretty continuously throughout this section, as composed of kind of two component parts. The first, intuitively, is kind of the first party data, the on us data. The goal there is to really generate, again, that 360 view of the customer relationship within your four walls. Again, you own all this data. It seems like it should be easy to achieve. It's not. It's a really hard problem to solve, to bring these pieces together in a structured and adaptable way. That can include elements as simple as customer data, account data, but as Sarah mentioned and Olivia kind of brought to life, the engagement aspect of the transactions, how the customer is actually engaging with the brand, are a really important and often kind of overlooked aspect of this data ecosystem. The other essential part, which is becoming more and more critical as we think about the competitive nature and constraints that are, you guys are facing in the broader market, is a better understanding of this customer outside your four walls via that off-us third-party data. Again, challenges exist there in terms of bringing that in, integrating it into your kind of ecosystem, but it's a really important unlock as we start to talk about customer value, to making sure that we're thinking about the opportunity that exists with these customers to either grow the relationship and kind of acquire more than our fair share, and or make sure that when we're in the prospecting space, we're acquiring those right customers that are kind of not just rate sensitive, and taking into account elements that are not financially related that become super important, again, to who that customer is and ultimately plays out in how they engage with your brand. And all of that comes together again for the customer spine and the activation there. So again, hard picture to solve, a lot of pieces here, but at Curinos, we do believe that even though this feels like a big vision to undertake, there's still an opportunity to think about unlocking incremental value as we move towards this kind of, data transition and customer-centric evolution. And so if you jump to the next page, I'll touch kind of briefly on how we think about these chapters progressing. So in the first chapter, kind of starting where you are today, I think a lot of banks kind of get stuck in, I just have fragmented data. How am I going to get value out of this? I think there's a moment to kind of pause there and say, even with our fragmented and potentially siloed data, or data that's specialized to different teams, there is still an opportunity to think about customer value as we start to build towards the bigger picture and activating these workflows in a really intelligent way. And that once we have that pattern established, it's only going to reinforce and get stronger as we start to bring more data and make those kind of different workflows more connected versus kind of specialized, which brings it to kind of chapter 2 in terms of really starting to invest in that customer spine, building a vision for that scalable infrastructure that's going to give you an understanding or kind of a roadmap to scale for how each additional data layer is going to bring you additional value in terms of understanding customer value, as well as activating that in real time with your teams, whether that's an engagement or pricing or product or other components of that. The last component of that, which is, some can be often overlooked because we're so focused on just getting to that data asset. Once we achieve that kind of, palace on the hill, are we ready to activate? Having a great, adaptable, robust data asset doesn't go really anywhere or brings us back to step 1 if all we're doing with that data is kind of connecting that to already siloed teams and ecosystems and decision patterns. The more we can bring that customer spine and that data asset and directly connect it to how we are ultimately going to engage with those customers in an intelligent way is ultimately the secret sauce for kind of unlocking this real customer centricity. And I'll talk a little bit more about some examples of tooling that we can start to unlock, that this spine helps us unlock as we kind of move across this evolution. But I'm going to pause quickly on a poll and give you guys a chance to answer that. So the poll here is, what is the most pressing challenge you are facing right now in relation to actioning on customer value? Either existing but varied definitions of customer value across verticals, lack of any trustworthy customer value metrics or measures, lack of leadership buy-in on the importance of customer value as a long-term measure of success, so a little bit of the incentive misalignment, or siloed action by disparate teams resulting in fragmented customer experience. And I'll give a couple seconds for the team to answer that. And as those answers come in, I'm going to jump to the next section so we can make sure we leave some time for questions at the end. So again, I want to kind of connect this to some examples of kind of tooling and the reality of like when we talk about CLV, what does that actually look like in terms of kind of a sequence of workflows that you guys can think about kind of supporting with this metric? Again, step one is really around quantification. This is easier said than done. I really want to drive that point home. Quantifying customer value is not as simple as creating one grand prescriptive metric, and it's also not as simple as creating a bunch of idiosyncratic definitions across the teams. A singular methodology that unites these pieces together, that understands the connectivity from the teams and the specializations which we need to have. We need the relevancy of the success kind of across those specializations, but understanding how we're then connecting that up to an umbrella understanding that becomes the democratized mechanism for the broader group and for your kind of the cross-team understanding is a super important element to understand. And I think this reinforces the similar point. The siloed action by disparate teams resulting in the fragmented customer experience. We hear that really consistently across our clients, and I think reinforces again how challenging this first step in isolation really is. And again, kind of exploring that spectrum of the aggregation to the component parts, it's important to toe that line really effectively. We can move towards this aggregated kind of singular metric, but we potentially lose sight of what are the kind of composable elements that go into that, and how do we want our teams to think about each of those different layers. So again, a lot of hard question to solve in terms of the methodology, but a ton of reward if we can unlock this first step in how we then activate across the kind of next steps of workflows. And if you jump to the next page, I'll talk a little bit more about how we then start to action on this. So there's a step here of kind of decision support that's super important around measuring and tracking customer value in a consistent way. So again, making sure that we're understanding how some teams are going to be using this in distinct ways, but thinking about it consistently so we can always be drawing this thread back to the connectivity of ultimately how we're going to go set goals and action on it with the customer. This includes elements around having reporting in place that kind of reinforces this standardization, as well as some score-based segmentation or customization that we've seen at some clients be really effective, and making this a little more interpretable across different silos and allowing us to socialize quickly. Ultimately, this is going to give you that insight into customer journeys, the retention aspect, tracking all those kind of different pieces and data aspects that Sarah touched on at the beginning. But there's one important caveat here, which kind of segues into the next page, which is, especially at Curinos, we reinforce this really strongly in kind of our product development process. Decision support should never be isolated from the eventual execution. It's really important for this workflow to be coordinated and integrated. As you guys kind of elevated in the other poll, coordination orchestration is a really hard part when you have teams who are working in really specialized verticals and need to be doing that, but then still achieving kind of the handoffs across these. So we think it's really important that we don't get stuck in the trap of kind of over-indexing on admiring the problem, getting mired in the analytics and the potential kind of trap of, the false sense of accuracy that we can sometimes get from just cutting this, 11 ways to Sunday. So that's an important part of kind of connecting these two pieces together. Again, it's reinforced in a lot of how we think about our product workflows. There's also an element going back to the customer spine. Once we start to have that adaptable layer, connecting AI into it in a couple different ways, one being even just a feature element. When you have that kind of full data asset, you're going to be able to potentially activate more proactive alerts that AI can help you drive. You can specialize that across teams, but really then focusing on where do I want my team to go take action and not just get lost in kind of the analytics, but proactively push these kind of actions to me so I can pay attention and react to real-time shifting customer preferences. We see this play out kind of on a person-to-person level in our engagement layer with CRM. We can also see this with operational teams who are looking at a ton of different dashboards, a ton of different data. There's a lot of different places where they can focus. AI features can kind of help traverse on both of those spectrums. And then a last really important component here is connecting historically siloed paid media ecosystems or the acquisition use case to your own engagement focused channel. And again, this might seem, kind of a bit of a paradox. These are two really different execution mechanisms. They have a lot of different constraints, but it's really important that we utilize that customer spine across these phases, which are really just a life cycle of a singular customer. And right now siloed just because of the nature of the bank and the coordination. So that's a big opportunity to close that gap more holistically. And again, all of this is supported by investment and understanding of how you guys are either going to buy or build a complete kind of workflow and tool supporting ecosystem. So that includes traversing all the way from analytics, so I can understand my bank more, peer benchmarks, so I can get a sense of how my competitors are acting in this space, opportunity analysis, scenarios to de-risk the action I'm going to go take, and really importantly, intelligent execution at the end, where we're utilizing that customer spine to really activate AI and decisioning intelligence at a scale that historically has been really hard. And we're now kind of at the the next chapter of being able to do this because of where we're starting to kind of bring the data and where AI has kind of gone. So I'll pause there. Let's jump to the last poll, and then I want to leave time for a quick wrap up and any questions the group might have. What's blocking you from growing customer lifetime value today? We don't have a reliable measure. Our customer value definitions are inconsistent or missing. We can't act on what we know. We have insights, but we lack execution pathways. Our teams work against each other. The siloed decision creates conflicting customer experiences, a little bit of a reinterpretation of the fragmentation one previously. Leadership doesn't prioritize it. We lack buy-in for long-term value over short-term metrics, or we're not blocked today. We feel like we do this really effectively and are confident with where we're at. Which one of those do you feel is most relevant to your institution?
So curious where this one's going to net out. It's been
too.
interesting to see sort of the distribution of responses, but it seems consistent that there is not necessarily a common lens for understanding predictive in a predictive way customer value, and that perhaps it might be a bit of a political hot potato, right? And that having kind of, if imperfect, a standard lens is a really, really important thing that banks need, given the incredibly competitive environment that we're in and the challenges we see on both the cost of acquisition side of the equation and on the quality of customer on the sort of existing customer side, and the need to be able to acquire customers, making the right targeting decisions, pricing decisions, experience for all the way through conversion decisions on the acquisition side. And then again, on the existing customer side, being able to engage those customers that are most likely to be high value, long-term, stable customers for you over decades, not 365 days. And then have relationship pricing that makes sense. So all of that decisioning does center on a shared understanding of customer potential value, and as a sort of foundational metric, really, really important. So we've talked a lot. We are curious to hear any questions that folks in the audience have. Just want to say thank you for listening and for your active participation in the polls. And we are happy to answer questions for the last little bit here.
Sarah, maybe to quickly bubble up a question that has come up actually from a client directly related to the content we just covered and to kind of vocalize it for the group. If I subscribe to Deposit Analyzer today, how can I think about stepping into the activation of customer value? Is this part of my product subscription right now? So I want to kind of touch on how I think this is a really good example of our chapter 1 in terms of kind of our data ecosystem. Right now, in our kind of deposit analyzer and products, we ask for just a partial view, deposit centric, kind of focus on that customer and account view, that lets you kind of start with that fragmented element, but still activate kind of an initial view of CLV. And that's one of the things that we're starting to kind of test into and build a new methodology and kind of a new product suite around that we're calling Curinos 1. There's a lot of really exciting exploration happening there, but there are still flavors of this that you can actually see within the deposit analyzer today in terms of breaking down the different segmentations around retention, vintage, scenario analysis that get at some of these drivers of customer value, even if we're just talking about that singular kind of workflow specific to deposit pricing.
Yeah. I think going back to you made the comment along the way, perfect is the enemy of good enough. And really the most important thing here is to get started within the context of a specific use case. And that could be a deposit focused use case. It could be a, cross-sell relationship based use case. But you don't need to boil the entire ocean in order to have a productive point of departure here.
Sarah, I'm seeing one other question in the chat,
ahead.
actually. Do you have any insight on the number of accounts for Gen Z or any Gen Z cuts for the first part of the webinar?
Of course, it's limited because I would say under 18, we're not keeping or doing any research with, but the short answer is yes, we have some Gen Z questions and or some Gen Z stats. I would say it's more intensely competed, less attention span than all of the generations prior. So it's just sort of even more important to identify, hey, where do we have, maybe a weak attention signal to start, but one that has a probability of developing. So even harder. And for anybody still on that is interested in sort of more discussion on this topic, definitely let us know. We are conducting some roundtables over the next few weeks for deeper dives into this topic of CLV, and would love to engage if you are so inclined. So thank you all very much, and let us know, or your main Curinos point person know, if there's interest in participating in a local roundtable.
Thank you guys. Thank you, Sarah, Olivia, and Tazmin for joining us today and taking time out of your day. And thank you to everyone on the call for spending the afternoon with us. Again, if you have any questions, you all have my email as well. So if you want to connect with our friends at Curinos, I'm happy to connect you all. On behalf of CBA, I just want to thank you all for joining us today, and you may now disconnect. Have a great afternoon.
Thanks so much.